All right, everybody, welcome back to another episode of the Discovering Multifamily podcast. I'm your host, Anthony Scandariato with Red Knight Properties. And today we have a special guest with us, Chris Seveney. And Chris is a senior level executive. He's got over 20 years of leadership experience in managing very complex real estate projects. He's been involved in over 1 billion new construction and renovation projects, particularly as it relates to mostly multifamily. He's done some office and retail and mixed use and some government as well. But obviously the show's catered around multifamily. But Chris has a pretty interesting side business, if you want to call it, from his day-to-day job. He's actually director of construction at tower companies in the Maryland area. And it's node investing. So we're going to talk about what he does and how, how you can use node investing as an investment vehicle that's a little bit different than traditional equity investing. So I definitely want to hear his perspective and what he's up to and how that relates to multifamily and the commercial side. So thanks for coming on, Chris.
Thanks, Anthony. How are you doing today?
Great. Can't be better. So thanks for coming on, and love to hear more about how'd you get started in node investing and what are you focusing on, and how can you educate me and my audience?
Yeah, so I got started in node investing about 3-4 years ago, and how I got started was, like I said, I've been in real estate and construction for over 20 years, and I started out for 10 years working for a large commercial general contractor up in Boston. And this was from 97 to 07. And during that time, a lot of multifamily was going on in that area. And then, of course, we all know what happened in 2008. And at that point in time, I relocated down to the DC market and actually was still with the same firm up in Boston and doing some work down here. But after 4 or 5 years, you start to get burnt out working on general contractor side. So I made a flip to the development side, and I was working for a local DC based developer that all they did was residential. And I was overseeing their multifamily division, and the vice president I was working for also, had a lot of other personal investments. And that's the biggest difference I noticed from, working on the GC side to, I think, the, development side developers side is much more entrepreneurial. In the sense of the GC side, honestly, you just work in, 7 to 7, 6 days a week. You don't have time for anything else. And then on the development side, hey, you put all those headaches onto the GC and let him manage the 50 subs on the job. So I started buying up some, buy and hold rentals in the area, which needed some rehab. So I was doing that, but with a wife and kids, you can't scale that. And it was very difficult to scale while also working the 9 to 5. So I landed upon, saw someone who did node investing. And I thought it was interesting because, having been in real estate for almost 20 years at the time, I never heard of it. And, basically what node investing is, and I do it on the residential side. You can do it on commercial multifamily, which we'll talk about in a minute, because, there's going to be a lot of opportunities, I think, coming down the pipeline for investors in that business. And what it is, the banks sell loans that are distressed, and they'll sell them to hedge funds and they make their way down. And, most people will ask the first question, well, why are you buying debt that's distressed? The person's not paying. And, the comment to that is because I'm buying it at 30 to 50 cents on the dollar. So if somebody owes $100,000 on their mortgage, you need to know what the property's worth as well. That's a major component. But if you're paying maybe 30 to 50,000 for this debt, it gives you a lot more flexibility to work out a renegotiation with that borrower to get them on a repayment plan. And that's really the focus. I don't do it to try and get the property. I do it to try and help borrowers and rework the deal, basically rework the deal with them, just like what's going on in today's world with, leases and other deals. Lenders are reworking the financials because at the end of the day, as the lender on this, I don't want the property. I'm lending, for a specific reason. And so, I did some training online with some people, and kind of, having that real estate background, really assisted in understanding that component, as well as kind of the finance component. Because when you start reviewing these things, it's kind of, you run the pro forma, look at the yields, look at your exit strategies, similar to almost like a multifamily deal in that sense, where you really want to run through everything to see where it lands and make sure you're hitting your target IRRs on these things.
Sure. So you're dealing with it on, it sounds like, the single family side.
Yep.
How does the financing aspect work for this distressed debt from your perspective? How do you look at your underwriting compared to a commercial multifamily that's traditional equity investments?
Yep. So the way it typically works is it's very similar, where you either bring in a partner, or raise money through a fund. The difference is, the major difference is the returns on a typical deal. With a multifamily, you may come in with 20% equity and, give a pref with, basically an 80-20 split or something along those, 75-25. And note investing, the typical deals are the investor brings all the money, the sponsor is the one doing the work, and profits get split 50-50. So, it's a much different scale, in this fact of a $20-50 million multifamily, or even, $2-3 million multifamily, compared to a $50,000-$100,000 investment. And that's kind of why the split, it's still got to make sense for the sponsor on that component to it. But from a yield perspective, on distressed debt, I target a 30%, IRR, and on the, performing side, trying to get in the mid-teens. So, and on average, I'd say, you're typically, if you're doing it right, you'll hit in the low 20s to 30. So, when you end up looking at the split, the investor is getting somewhere in the mid-teens is the target that that I target. So, it's varied for other people, but typically it's, you try and target mid-teens returns for the investor.
Sure. And so how do you find these opportunities? It's not like the banks, like you mentioned, the banks reach out to hedge funds and other institutions. First, how do
Yeah.
you get in with that network?
Yeah, and it's like the old boys club. It's similar to multifamily when you're trying to source deals in a certain market. You got to know who the players are. It's a really small niche industry. And again, there's a residential, the commercial side. It's, I've dabbled a little bit in the commercial side, on a few, I got an 8 unit, in the Midwest, and that is typically, commercial lenders who've got something that's distressed, but a lot of times it's an office building that's going to be really challenging. And, what they're looking to get for the paper is probably more than what most people are willing to take on the risk for. But on the residential side, it's typically, the larger funds, getting to know them, and, basically building a relationship with them, and making sure that you're somebody who'll close the deals. Similar to every aspect of real estate, they want to make sure it's somebody who's going to step in, close the deal on time, and not, basically give somebody a runaround. And, a lot of times where you'll find some assets is, a lot of these funds are closed end funds. So they've got, they got a sunset period on them. And if you can find out when that sunset period is, 3 to 6 months before that sunset period is, you're basically like a shark, in blood infested waters, because a lot of these funds are starting to look to liquidate a lot of those assets. And as it gets closer to that point in time, the better the deal you might be able to get. But you got to be careful, because a lot of the good stuff sells early, and what's left is usually, the worst paper that's out there. So, a lot of due diligence is involved with, title reports, and, and doing, getting appraisals on properties. And it's challenging because you don't get access inside the property. You have no clue what it's going to look like on the inside. It's literally somebody on the outside, because you don't own the property. You're just, trying to guesstimate what the value is to make sure you're not overpaying for the loan in case you do have to take it back down the road.
Yeah, can you talk about that due diligence process a little bit more? How is it different than traditional? And you mentioned one way. Is the time frame also different to conduct your due diligence than traditional?
It's much different. Depending on, most of the stuff I buy is in, pools of, 10 to 50 to 100 assets. And when you're doing that, typically you're closing, in about 2 to 3 weeks. It is lightning fast. And, when the way the process works is they'll put out what's called a tape, which is a list of assets that give some specific information. What's the unpaid balance, the interest rate, principal and interest, last due date, last payment date, estimated value of property, which is really like an AVM, which is, basically it's like a Zillow value. And, so you'll bid off of that. And, your bid is, basically it's based off of limited information. So once once it gets accepted, a lot of times you will adjust your bid down the line, because if they thought it was worth 150 and it's only worth 120, you're bidding off of the lower of a percentage, typically of the lower of the value of the unpaid balance or the property value. Because when you run it through your modeling, your foreclosure, what you can get for the property, if the value is less, adjust the returns on that. So, the first thing, I do is I always make sure I already have boots on the ground in that area. So I'll have typically a property manager and a realtor go by the property, take a lot of photos, kind of get a feel for what's the property look like. Does it got 3 inches of grass? Is there a pit bull running in the yard? Things, is there, a lot of times, is there pride of ownership in the property? Because typically what the outside looks like usually mirrors the inside, in some sense. So that's the one component, is understanding, okay, what's the value of the property? The other component is, you do a full-blown title search on the property, because you want to make sure I only buy first position liens. There's HELOCs and things people can buy. So you want to make sure you're in first position. Have the taxes been paid? Are there liens on the property? Is the assignment chain from the original mortgager down the line to, whoever's selling it, in order? Because if there's a break in the chain, that can impact your foreclosure if you need to foreclose. The other key component that you want to get is, these are all serviced by third parties. To make for Dodd-Frank and everything, you never want to service your own loans. You want another company to collect all those payments, and you want to get their comments, because you can find out people's life stories, what they tell these servicers of why they haven't paid or what the discussion is. Because you'll find some borrowers are just that, professional borrowers, where they've been able to go 3, 4, 5 years without making a payment and still be able to stay in the house. So, and a lot of times, some of these people, they'll use it as rentals. They'll get the rental, they'll collect the payments, and, lo and behold, some of these hedge funds, they have so many loans. Some of them they just put to the back burner and don't pay attention to it. So a person's like, out of sight, out of mind. I'm collecting rent. I don't have to pay. And eventually they're going to come for me. But, in the meantime, I might as well keep doing what I'm doing. So yeah, the due diligence is, it's a very quick, you got to have your ducks in a row, because typically, like I said, sellers want you to close in, 2 to 4 weeks, depending on the size of the package that you're buying. And then the interesting thing is, once you close, you're basically, then it's like, then you kind of just sit and wait. When you close on a multifamily building, it's like, hey, I own it. Now I can start implementing everything. This is the exact opposite, because what needs to happen is whoever you're using to collect the payments, all that data is going to get transferred, which takes about a month. And then they have to send out a letter once it's transferred to say, hey, this is where you send payments to. And the person has 30 days to review and confirm the debt. So you rush to close a deal, then you sit back for 2 months with, twiddling your thumbs from that perspective. So that's, very different from, the conventional real estate. Now, what's one thing why also I got into this was, I joke that I do this from midnight to 2, because you can do this at any point in time during the day. When I'm bidding on an asset, I can do it at night. If I need somebody to go buy the property, hey, I can send them an email at night, and maybe they go by during the day. But it's one of those things where, it's not like I'm looking to buy property locally where, okay, I got to coordinate with an agent, get in at this time. And I've got soccer, basketball, swimming, dance, with all the kids. And it's like, okay, when can I go look at this property? Because honestly, I don't have that time. So that's one of the key reasons why I got into this is, go back to my project management days of the GC side. I'm project managing essentially remotely wherever in the world you can do this. You could do this on an island somewhere as long as you have internet, essentially, because you're outsourcing everything.
Sure. No, it sounds very interesting. And like you said, in some aspects, still relatable to traditional commercial multifamily equity investments. Besides the waiting period when you close,
Yeah.
that's something I don't know if I could stomach with. As
Yeah.
soon as we close, I'm like, all right, let's go. Let's.
Yeah. The biggest difference is, and again, investors who invest in that multifamily realm, when you send them, or the PPM or the documentation, and they see how the structure is, like, wait a second, I'm used to getting an 8 pref or with an 80-20 split. With me getting an 80, on some of your funds, it's maybe a 10 pref, but it's 80-20 the other way around. But when you look at the minimal management fee, and it's call it, these aren't large, depends on the size of the fund. If it's a $2 million or a $5 million fund, when you look at a 1% management fee, that's $50,000 a year. And then from the equity splits and so forth, it's not for the sponsor, it's got to be catered to that percentage, just so they can actually, it makes it worth their while, which is what you want, because you don't want, of course, your sponsor not having, part of the investment, getting the part of return, because, if the management starts to go, south, are they really going to, take the most focus on it from that perspective?
Sure.
So.
Sure. Definitely. And how long have you been note investing, Chris? For
4 years. So basically started 4 years ago, and it took me about 6 months to really, pull the trigger on it. And the way I started doing it was when I had switched jobs, I transferred, instead of transferring the money from one, company's 401k to the other. And again, this was another thing that blew my mind, was they're like, oh, you can just, self-direct your retirement funds. I'm like, what do you mean? They're like, yeah, you can just go put them in an account with, Quest Trust or Mid-Atlantic IRA and do what you want with them, invest in real estate. And I was like, damn, nobody, there's this stuff that, you're so busy, you don't even know this stuff exists. So I rolled all that money into an IRA, and I just started, buying some notes. And I started out buying some low dollar ones just to learn the process. Who are the players? Who do I need to hire? What are, some of the attorneys? Who do you want to be involved with? And I found, my general counsel is an attorney out of Maryland who he's a rock star, and I love him. And he is a real estate investor, and he represents a lot of large hedge funds. So he knows this business, and, he's basically kind of the little guy on my shoulder, because he keeps me out of trouble. I'm always ultra conservative in how I approach things, but he kind of mimics that. So we work very well together. So, and it just, from there, the first year really was just kind of get up and going. And then once you get going, it's kind of like riding a bike, and same thing with multifamily. After you get the first one or first few, you get that itch, and then, you get financing or lending partners, and then you start building, the relationships with people. And then, people start bringing you deals. And once that starts happening, you continue, the growth just goes exponentially.
Sure. And so for our listeners, how can they find you, Chris, if they want to learn more about note investing? And because it sounds like it didn't take you too long. The learning curve wasn't too bad, a few months. So I'd love for, if some of my listeners are encouraged by what you hear by Chris, definitely to reach out to you and to learn more.
Yeah. So to learn more, I do have a podcast called the Good Deeds Note Investing Podcast, where kind of I've told my story through the podcast. And if you want to reach out to me via email, you can reach me at Chris at, then it's the number 7, the letter E, then the word investments.com. So Chris at 7einvestments.com, or, you can reach me on my cell phone at 202-304-2784.
Great. And we'll have a link to all the websites, phone numbers, and emails that Chris just mentioned in the comment section on our social media, and also in the iTunes section of the Discovering Multifamily podcast. So you'll be able to reach out to Chris directly, or feel free to reach out to me, and I'll put you in touch with Chris. So, Chris, we're just going to wind down the show now. Really appreciate you coming on today. And definitely learned a lot. I'm not too used to the note investing. I've looked at some deals and could never really wrap my head around it. So, I'd love to talk offline after. And thanks again for coming on.
Yep. Thank you for having me on, and yeah, definitely happy to chat offline and tell you a little bit more about it, and also if you want to talk offline too about kind of some of the opportunities that are probably coming in the commercial realm with the defaults and so forth with the paper. Be happy to share my thoughts on that.
Great, thank you. Appreciate it, Chris.